How are you? Enzo Di Cinzo podcast, and we're going to look at minority interest, and we're going to look at another problem in the managerial economic chapter, and let's get right to it. We are going to look at Superior Manufacturing Company, and we're going to compute cost of goods manufactured schedule, and we're going to prepare income statements. So this is all going to be good in the Excel. Okay, but before we do that, let's spend a few, because this is not going to take too long. Let's spend a few minutes looking over non-controlling interest, which again it was quite a topic in the healthcare deal that we're working on. It's also known as minority interest, and we've discussed this, and I think in previous videos. Where ownership position is less than 50% of outstanding shares and no control over decisions. That's minority interest. Non-controlling is measured as the net asset value of the entities and does not account for potential voting rights. And it's how these are measured, non-controlling versus minority interest. Most shareholders of public companies would be classified as non-controlling interest, even though 5 or 10% equity stake is considered to be a large shareholder in a single company. Non-controlling interest may be contrasted with controlling or a majority interest in the company, where the investor does have voting rights and can often affect the course of the company. So non-controlling interest is also known as a minority interest, is an ownership position whereby a shareholder owns less than 50% of the shares outstanding. As a result, minority interest shareholders have no individual control over corporate decisions or votes by themselves. A non-direct or direct non-controlling interest receives a proportionate allocation of all pre- and post-acquisition amounts. Recorded equity of a subsidiary. An indirect non-controlling interest receives a proportionate allocation of subsidiary post-acquisition amounts. Okay, and the opposite of a non-controlling interest is a controlling interest, where the shareholder has voting rights and determines corporate direction and decisions. Okay, so a very legal term, to no doubt there. So most shareholders are granted a set of rights when they purchase common stock, including a right to a cash dividend if the company has enough earnings and declares a dividend. Shareholders may have the right to vote on major corporate decisions, such as a merger or company sale. A corporation can issue different classes of stock, each with different shareholder rights. There's two types of non-controlling interest. There's direct non-controlling and indirect non-controlling. Direct non-controlling receives a proportionate allocation of all recorded equity of a subsidiary. Indirect non-controlling receives a proportionate allocation of a subsidiary post-acquisition amounts only. And the direct one is pre- and post-acquisition amounts. Again, now you're getting into, again, my big, I like to use percentages instead of shares in terms of these acquisitions, where there's people who are very married to this idea of a shareholder and think that a magical thing happens if you're a shareholder. Okay, I mean, you need insurance, and there's so much more to it than just the upside. Okay, and this was a quote of mine. I think in the last couple months or so, I said, if you're an owner, you own it on a good day, you own it on a bad day. You own it on the day the company gets sued. You own it on the day the company does well financially. You own the company on the day it has losses. So you own it all those times. You own it. Okay, it's not just on a sunny day and that's it. You own it across the board. When it's good and bad weather, you own it. So it's generally not until an investor controls 5 or 10% of the shares that they communicate specific proposals to the board and management, propose changes to the board of directors, propose changes at shareholder meetings, and team with other investors to make their actions more likely to succeed. And such investors are termed activist investors. They range widely in style and of action and objectives. Objectives range from seeking operational improvements or restructuring to natural environment and social policy. Okay. Now, how the financial statements are viewed with this. See, this wasn't that long. Consolidation is a set of financial statements and non-controlling interest. A consolidation is a set of financial statements that combine the accounting records of several entities into one set of financials. Parent company as the majority owner, a subsidiary or a purchase firm, and a non-controlling interest company. The consolidated financials allow investors, creditors, and company managers to view three separate entities as if all three firms are one company. Okay, so let's look at that again. So you're combining consolidations. You're combining accounting records. Fine. Okay, a parent, a subsidiary, an acquired firm, a non-controlling interest company. The consolidated financials allow investors, creditors, and company managers to view the three separate entities if they're just one company. Consolidation also assumes that a parent and non-controlling interest company jointly purchase the equity of a subsidiary. Any transaction between the parent and the subsidiary company or between the parent and the non-controlling interest firm are eliminated before the consolidation financial statements are created. And here's an example. So if a parent buys 80%, a parent company buys 80% of XYZ firm, there's a non-controlling interest of 20%. Parent company buys 80% and that a non-controlling interest company, okay, another company buys the remaining 20, right? Okay, fine. So company one, parent, owns 80% of a subsidiary. Another company owns 20%. What's left? The subsidiary's assets and liabilities on the balance sheet are adjusted at fair market value, and those are used on the consolidated financials. If the parent and the non-controlling interest pay more than the fair value, the excess is goodwill. And in the consolidated financial statements, goodwill is an additional expense incurred to buy a company for more than the fair market value, and goodwill is amortized into an expense account over time after an impairment test. This is done using the purchase acquisition accounting method approved by the Financial Accounting Standards Board. I know somebody on that board. There's a graduate of one of our schools in New Jersey that I think still serves on that board. I'm not sure. 2023 may have been the end of his time there. Let's check out if he's still there. Yeah, Gary's gone. Gary's gone. Yeah, he's not. I thought 2023 was the end of his time. He was up. These guys were up in Connecticut. 7-year term. This is. Yeah, I don't see his name. I think I knew when we had spoken to him. Here's Gary, which is right there. Couldn't find what you're looking for because he's not there anymore. So Gary, yeah. Gary went to school in New Jersey. He's a CFA. There he is. A good guy. A good guy. Yeah, his term concluded. I don't know if he was eligible. So I knew it was 2023 sometime. Diversity. Yep. Oh well. So yeah, that's that one. Okay, that's non-controlling interest. So we briefly discussed it, a very legal definition there, and now we'll spend the rest of the video lecture on a Superior Manufacturing Company. Has the following cost and expense data for the year ending December 31. And you're list. I think we counted these 1, 2, 3, 4, 5, 6, 7, 8, 10. Yeah, 20. There's 20 financial data points there, and you got to sort through them. I mean, we did it already with the template, so it sort of clears it up a bit. But it just prepare cost of goods manufacturing schedule, prepare an income statement, and then you're given some balance sheet information. And the book has it, but we like we like doing our own. All right, there's a partial balance sheet and income statement. Okay, but let's get going. And there's an action plan. Start with the beginning, work in progress. Sum the direct materials, direct labor, and total manufacturing overhead to determine the manufacturing costs. Some beginning work in process and total manufacturing costs to determine total work in progress. Cost of goods manufactured is the total cost of work in progress less ending work in progress. And the cost of goods sold section of the income statement show the beginning and ending finished goods. In the balance sheet list manufacturing inventories in the order of their expected realization and cash with the finished goods first. Okay, so we have our model. Let's get to our model video. Okay, so we've sorted through all of those data points is what we've done. We've sorted through all these data points. Yeah, this is not giant. This is not giant manufacturing. It is not that. Okay, we're here with this. We have the numbers there. We have the income statement, cost of goods manufactured. Okay. And now since you have the numbers sort of already, yeah, you got all these numbers here. Okay. So raw materials, so material purchases. So yeah, here the first three, all raw materials: 30,000, 20,000, and 205,000. Okay, you have all those. That's 17 more to go. You have the beginning and the ending work in progress, 80,000 and 50,000. Direct labor, 350. Indirect labor is 90. Utilities in the factory, 65. Machinery rent, 40,000. Factory managers, compensation. Depreciation in the factory building. Okay, you have all those. Then you have the finished goods numbers. Here's the finished goods when you start at 110 and 120. You have and then here's some income statement numbers. Net sales 1.5 million. Sales commission and the aggregate sales commission 150,000 and administrative expenses. Okay, so we put of all 20 of our data financial fiscal financial data points. I have the sort of these things typed in here, but you shouldn't do it like that. This should look like this. All right, it should look like that. But this, we're doing educational stuff here, so there's a little bit of training wheels, still on it. So let's prepare the cost of goods manufactured here, and we have our whole process here. What we're starting with: beginning work in progress, adding up direct materials, direct labor, manufacturing overhead, all those steps that we're looking at. So this is the data, and again, we sorted through. Here's delivery expense, sales commissions, net sales. Those all go together. And now, as you know, any CFO will tell you, the depreciation is tucked in there, and it is. It's tucked into the managerial numbers, all right, which it is. Okay, so you have that. Okay, so you're starting here, the work in progress. We can do it like this too. So directly references the numbers. There's 80,000 there. And your ending work in progress is 50,000. No problem. You're going to do raw materials. When you start with 30. Purchases 205. And ended with 20. This equals sum. Right there, 235. And direct materials used, you just subtract these. There's your 215. Okay, you have that one. Direct labor, 350. Okay, and then you have all the other pieces here, which are right there. So we can even start from the bottom here. And we could type them. This is that 6,000. Here's 14. There's 15. There's 24, right? Again, all referring to your manufacturing, the rent, the manufacturing facilities rent, 40, and then 65 and 90. And again, these are listed here, sort of in the perfect order as you're doing them too. So, okay, and then you slide over right there. So your total manufacturing costs are these three numbers. All right. That's 854,000. 215, 350. Okay, all the manufacturing overheads added up, all that. So the total cost of work in progress is at 854 plus 80,000. Okay. And this is just going to be total work in cost in progress minus 50,000. That's 884. That number, when you look at your income statement, that 884, this is cost of goods manufactured. That equals that 880. That's where that comes from. See? Right there. Okay. And then finished goods, your initial finished goods, and you can find that up here. That's that 110. There's your 110, which is right there. This is the 120. Finished goods at the bottom. And cost of goods available for sale, you just sum those two numbers. Okay. These are both 0. Sales revenues at 1.5 million. Okay, which is there. So we're going to sum these two. 1.5 minus that 0, so 1.5. Okay. So cost of goods. So this is what's left. This is what was available for sale, was the 994. You subtract these two. There, 874. And your gross profit is just the net sales, 626. Okay. Now, as you're looking through all of this, so there are some other entries here. You had administrative expenses. So this, actually, what you have here, this is gross profit. This is calculation of income from operations. So these are non-operating numbers, which don't have any. Those are all 0. Okay, but your operating numbers are here. And we could type them in, or we could say, we can just administrative expense, 300,000. Commissions are 150. And depreciation expense is 100. Somewhere it's 100. There it is, 100. Okay. Everybody else is 0, 0, 0. Add those up, that's 550. So income from operations is just the difference of the gross profit minus the 550, which is 76,000. Here's the math on that. This one minus the total expense. It's a little hidden here, a little obliterated, but you can see it's just that one, just that 550. The rest of these, those are the sums of the revenues. Those are the sums of the losses and expenses, of which we have none. So this is just that plus that plus that. Okay, gives you, again, net income 76,000. Okay, so we did the two tough pieces of this we took care of. Right, the cost of goods manufactured schedule, we took care of that. And now we have to work on a partial of the balance sheet. Okay, that's only a few entries here. So, and again, this is a manufacturing company. So I think with the cash, and these, I think these are just entered. We just enter these by hand because you're given 17,000 cash, 120,000 receivables, 26,000 short-term investments, 13,000 prepaid expenses. All that was just typed. This was all just simply just typed in because we didn't have it listed like we previously did. This is 120. Okay, and this is 13, 1, 2, 3. Okay. This is a sum of those three entries, right? 61, 62, 63. Finished goods at the end of the year were 120. Work in process at the end of the year was 50. And your ending raw materials were 20. Yeah, here's some of the numbers, and there you go. There's your total current assets of the balance sheet. Those added up: finished goods, work in progress, raw materials, and the initial cash, short-term investments, and receivables, and the prepaid expense, which is a cash amount for a specific expense. That's what it's called, prepaid. Okay, so that's this particular problem. My graduate course, you guys had to do the self-test questions here. These were these 14 or 16 or whatever it is, 15. that was the final exam. Okay, whatever those 15 questions, 16, 15, whatever it is. Okay, so yeah, those that required other work to deal with that. So that'll be for another another lecture. All right, folks. Again, this wasn't too long. Thank you very much. Okay. All right, folks. Thank you. We'll see you soon.